Hi there everyone, Rob McGregor here with the end of February edition of On Track. I'm recording this on the 13th of March. It's 8:30 in the morning and the world's gone a little bit crazy. Let me try and unpack that for you in this episode. I'm very conscious I'm recording this will be publicly available for a period of time. So all my views may prove to be completely accurate, or they may prove to be completely inaccurate. But what I will reinforce is the framework that we have is useful for guiding through these circumstances. Let me get into it, but before I do, this briefing is designed for clients of McGregor Wealth Management and predominantly for clients using our CARE investment methodology. For those of you that aren't clients, this is general advice, and everything I say here you should seek out advice before acting on. So I'm going to cover, as usual, the important economic news, although there is only one news that matters at the moment, and I'm calling that the coronavirus panic of 2020. I will put it into context, I'll talk about what's happening in the markets, and I will put it into perspective. So let me start with the news, and as I said, there really only is one lot of news, which is the coronavirus. In amongst that, we've been seeing pretty good profit reports coming through from Australian companies. Growth was around 1.8%. The RBA did drop the cash rate in response to this to 0.5%, so we're now at the lowest cash rate we've ever had in Australia. In the US, well, internationally, there's really only sort of three stories: coronavirus and the panic that's caused there, and I will talk about that in detail in a minute. It was a 1-2 punch. So as well as the coronavirus, we then had the Saudi-Russia disagreement, which saw oil prices fall. And while for most of that's a good thing, markets often react badly to oil prices falling as a potential sign of deflation and slowing world economies. Now, this is absolutely about Saudi and Russia doing a bit of argy-bargy, trying to agree on where oil prices should be, and then disagreeing, so we saw a drop. Now, for most of us, that means we've got more money because we're paying less for petrol, and for most people, that means they'll spend that on other things. So that's a good thing. But the reaction from the market was quite savage, and that sent us from just a correction into what is now a bear market. But I'll talk more about how that's unfolded. We're down to 2 in the US Democrats presidential nomination. So we're going to be watching 2 old men fight for president in November. It's a little bit sad. I can't say I'm excited about any of the candidates. All of what's going on right now might give Bernie Sanders and his socialist ideas a little bit of run. Trump has not done well the last few days on public announcements around this, and markets down are generally a bad sign for an incumbent president. I kind of hope Biden gets in, I think, but I reserve the right to change that opinion. And anyway, we'll see what that happens. So the theme was, in our conversations before, we'd been talking about low to moderate growth, low inflation, low interest rates. But the big question now is, will we move into a recession? And we probably are. Let's think about what a recession is. It's 2 negative quarters of growth. It's fair to say this quarter we're in may be negative growth, and only slightly negative, and next quarter may be slightly negative. That would put us in a recession. Now, in the past, the market has bottomed effectively halfway through a recession, or in the first 3 months of a recession, because we don't find out about a recession till later. If we are in a recession, the market may have bottomed, or may be bottoming right about now. And that would be perfectly consistent with history. The only real news, as I said, is the mass hysteria response to what is a relatively minor threat. Now, let me preface everything I'm going to say today. When people die from anything, it is extremely sad for their family, their friends, and obviously for them. I'll put the deaths for various things in a perspective in a moment, but coronavirus is effectively a flu. It's a very contagious flu. It appears to have a higher death rate than the flu. The flu death rate is about 0.5 to 1%. the coronavirus death rate appears to be, depending on experts, between 1 and 4%. We have a habit of taking the worst possible stats in current psyche, and I'll talk more about that as well. But the flu itself will not be the issue. The issue that's causing all the panic now is the response to it. So not the event itself, the coronavirus or flu, but the response to it. We've seen the NBA cancel the season in the US. I fear that the Olympics may be cancelled this year. I hope not. And we've seen share markets now move. They were hovering around the 20%, but the US market last night, so that for them was the 12th of March, dropped about 9.9%. So it's one of the biggest one-day drops ever. So we're now into greater than 20% drop. A greater than 20% drop is a bear market. We don't have many bear markets. They're on average every 17.5 years. So we're now in a historical event. And once again, I'll put that in perspective, and I'll talk about what you should do. But I'll give you a hint. It's the usual, don't panic. Your plan is good. Stick with the plan. So let's get into that. But I did want to just start with a quote from Warren Buffett. Now, Warren is the world's best investor ever. This quote says, "Be fearful when others are greedy, and greedy when others are fearful." Well, I can say I've never seen so much fear around at the moment in the masses. I'm not seeing it with my clients, so congratulations for not. There's obviously concern. Everyone's concerned in times like this, but I'm not seeing panic, which is great. We are seeing it in the masses. We see that with the great toilet paper sellout. And the masses effectively are pretty dumb when it comes to these things. And I say that with respect to all of us. But when the herd gets bigger, the herd makes dumb decisions. Warren Buffett stated this week he's never seen anything like that, because what we're seeing is this bear market, and it is now a bear market, will be the first bear market in Australia ever that's been caused by the hysteria around an event rather than a booming market, irrational exuberance, where the bubble was then burst. So we weren't in that state before this. So this is the first bear market that's been caused by crazy hysteria, and I'm going to talk about a model for that. Again, I want to just revisit, as always, very quickly those 4 pillars of your investment strategy. Our portfolios are well designed. They perform well in line with what we would call modern portfolio theory. Pillar number 1, and you all have a plan. Pillar number 4, that's based on your own unique circumstances. What we're seeing at the moment is bad investor behavior, pillar number 2. So for those of us that want to avoid any long-term damage, it's very critical to avoid making bad decisions during this panic. In fact, we want to make good decisions and we want to not mess it up. And I'm going to dive a little bit deep into that. I will talk about history. I will put things into perspective. We are now in a bear market. The preface, of one of the foundations of our process is that volatility in share markets is inevitable, unpredictable, and completely normal. This is the most unpredictable thing I've seen in 35 years of share market investing, and I'll talk about sort of why that's happened. But back to our context, back to our framework. So our framework says the market goes through 3 stages: the boom, the bust, and the wall of worry. And while it's in the wall of worry, we gravitate between expensive, fair, and cheap. The wall of worry is the rational stage. It's where markets move around a bit. We're always worried, but we don't see the irrationality of a boom where the fear of missing out takes over and markets peak at higher levels than they should, followed by a bust and fear. What is unprecedented in this one? This is the first bear market that will have been triggered when we weren't in a crazy boom. And it's been triggered by hysteria around an event, of which I'll talk more about in a minute. The framework holds up well. It still gives us a lens of the world to assess where we're at. And when I say we, the investment committee of GPS Wealth that runs our care portfolios, we are absolutely certain that we are in a fear state at the moment. So fear states, they don't come along very often. They come along about every 15 to 20 years on average. They always pass. like every storm, when we're in the eye of the storm, we feel like it's going to go forever. So, and this is no different. This is an economic and a mass hysteria storm. It absolutely will pass. We will see the other side, just as the sun will come up tomorrow. This has been exaggerated by the media, and our framework around mess it up starts with the media, and I'm going to dive deep into this in a minute. And let's get into, and let's have a look at some lessons from history first around corrections and bear market. Now, I've updated this slide 3 times in the last 3 days as it's got worse, but this is a slide which is the ASX 200, and it goes back to 1993. So the first thing I would point out is if you've been invested, you've had very good returns. The market's gone up and we've had dividends along the way. This slide doesn't include dividends. So you've received an average dividend of 5% during all that time, plus franking credits, plus the market, even at current levels, has gone up more than 2.5 times. So share market investing works if you're in it for the long term and if you avoid the big mistakes that happen around the market cycle. So we've seen along that way one big downturn, the 50% one in 2008, that was a response to FOMO. And you can see there that rise from 2003 to 2007-8 sticks out above the pack. It was irrational exuberance in perfect hindsight, and the market did correct, and we did get to a fearful stage in the back half of that drop as well. That was the last time we've seen fear, true fear in the markets until now. We had another 4 or 5 cases where the market went from expensive back to cheap, and we saw drops of 10 to 20%, which we always have said inevitable, unpredictable, and inconsequential because they recover generally fairly quickly. And you'll see all those 10, 11, 20% drops within a year to 2 years, they're completely erased. We're now into a 25% sort of zone. I'm recording this before the market opens on Black Friday, the 13th of March. I've got to say, I feel like we're around about the bottom. Emmanuel Caligaris, our chief economist for the CARE process, is pretty much saying this is close to the bottom. We're at fear. This will prove to be buying. It does not mean, and I just want to qualify, no opinion is any better than anyone else's opinion. We may be totally wrong about this, and as I said, this will be on record, and I'm prepared to be wrong about it, but we're in a zone. Picture these emotions of fear and FOMO, fear and greed is just fear of missing out, like a pendulum. It swings from one to the other, but the more it swings, the more it will swing back. It is a pendulum, it is a cycle. It's not a trend. Emotions are cyclical, and we go from fear to greed. So we had the greed in 2007, it went to fear. We didn't see FOMO in this cycle. We saw just a bit expensive in the wall of worry, and that's why this particular downturn is unprecedented in that the market has dropped. And I'm saying 25%. It may open at 23. It may be 30%, depending on where the market in Australia opens today. We've been somewhat cushioned by it in Australia for your portfolios because the Aussie dollar has dropped as well. So that's lessened the damage from our overseas investments. So they've done better than the Aussie shares during this crisis, and I'll talk more about that. But absolutely, we are calling the current state as at the 13th of March 2020 as a fear state. So very important to not do the things that people normally do in that state. Now, how did we get here? We've seen an increasing trend that I'm calling the vicious triangle. And it is like the vicious circle, but it's based on three things that are happening. We've got the media's increasing sensationalism at the top of the triangle there. So it's driven by the need for them to stay relevant in an age of Google News, fake news, and the fact that there is more media than ever before with social media in there. So the mainstream news has become increasingly sensationalism. So what they now do is and if we go to the bottom right-hand corner of the triangle, they grab the most extreme views and the most extreme forecasts they can find. So we've got this rise of the voice of the extreme. We see it in politics, we saw it in the bushfires, we see it in any weather event, We see it in any terrorist event. You grab an expert who predicts the worst possible outcome from whatever event is happening, and that then leads to the left-hand side of the triangle, where the nanny state now goes into protection or butt covering mode. So we get principals of schools suggesting that kids stay home. We get the Grand Prix being cancelled. We get the Football Federation saying we'll have no crowds at football matches. We get the NBA counselling. So we get executives and leaders who go, based on those worst case forecasters, go into protection mode. Now they think they're protecting people, but they're actually causing major crisis. And in the case of the coronavirus, we've seen this exactly play out. We're now acting on worst case forecasters. And let me reiterate again, the consequences for 96% of people from catching this are mild. It's at best case a minor cold, at worst case a flu. For the 4% who do die from it, it's massively consequential. And the reason we go into this sort of protection mode is we do want to protect the elderly and the sick. But I'll talk in a minute about death rates, and we all die eventually. And I'll jump to the point, 50 million people die every year, and they all die of something. And I'll put the death rates into perspective, but we are seeing this vicious triangle of the increasing sensationalism, the rise of the extreme voice, and then the nanny state going into protection mode. So it compounds the mess it up, with the media driving it, preying on our emotions, and we're now at the pendulum is fully pulled back on the fear stage. Could it go a bit further? Maybe, but not much further. We will see it swing back at some stage. We have a short-term focus on a single issue. These things always pass, as per the eye of the storm. They always pass, always. The sun will come up again, but right now there's this irrational focus on the short term. And some of the posts I'm seeing from the masses are quite crazy, and it all plays out in, the greatest example I've ever seen of it is in we have no toilet paper on the shelves in Australia. And anyway, that's an irrational response to what's going on. The challenge with mass hysteria is they get proven to be right for a brief window. So for the next few weeks, people will run out of toilet paper, and the people that have hoarded it will say, see, I was right. We do have enough toilet paper in the country, it will come out. So it's an exact case. And the mass hysteria, the people that are panicked during this downturn will say, see, I was right. And they'll be right for now, but they will be wrong for most of their lives. And they'll be wrong in that they will not prosper financially. They will not enjoy the rewards that good investing offers, and they will suffer. But right now they get to stand on their soapbox and say they were right. Rational people, and I will claim that, for me, we'll stand here and say, wow, we were wrong. We thought the market was due for a correction of around 10%, but the hysteria, the vicious triangle, the irrational fear has pushed us into a bear market. So happy to say I've been wrong in the short run, but I know that in the long run that will play out. So let's get some perspective. This was the most recent information I could find this morning on the deaths and occurrences of coronavirus. So as at the moment, we've had 135,000 cases around the world, and you'll see that split by country. So China still accounts for a big part of that, but we've seen a big rise in, say, Italy and Spain and France and Germany, which is why Donald Trump, in his infinite wisdom, decided to impose a travel ban on US citizens from travelling to Europe. And that's led to this last capitulation stage of the market. The death cases, 3,000 in China, 1,000 in Italy, which is significant. Yeah, and once again, in every single case of death, it's tragic, it's horrible to those families. It's predominantly death of the elderly and the weak, and the weak elderly. And I'm very conscious for many of our clients. We have clients in their 70s and 80s, so this will be a scary time for those that. And every year during flu season, we have the weak and the elderly die. It's not normally news, but this is big news at the moment, even though these numbers are relatively low. The death rate in China has slowed dramatically. In fact, the Chinese share market is the best performing share market of the last few weeks. China's actually on the other side of this, and they're back out doing things. They're back in production, they're back doing stuff, and it looks like it's slowed down. Let me get a bit of perspective here. Last month I talked about the flu season, and the flu season in 2017-18 in the US, 45 million people caught the flu. So that's 45 million. We're still at at 135,000 people from coronavirus. So it would have to get dramatically worse. And I'll just go back. So 45 million, and in the US for coronavirus right now we've got 1,500. So it's a fraction. It's a fraction of a percent affected. Death, 61,000 people died in the US of the flu a couple of years ago. In the US now we've got 40 deaths. So it would have to go up dramatically. Now, it probably will go up dramatically. It's probably going to get up to these type of flu levels. But my perspective here is it's still just the flu. Once again, tragic to those who suffer from it, but it's still the flu. 1.2 million people died of tuberculosis last year. 1.3 million people died from motor accidents. Every year in the world, 50 million people die of something. That's the normal death rate. There's about the same number of people born every year, and we do have a finite life. We will die of something. So far, coronavirus is not even on the map there, and even if it plays out into the worst possible projections from these people, it will still sit below or similarly to, and I'm not a scientist, I can't tell you this for sure, but it's likely to still sit below things that we already shrug off. Motor vehicle accidents, flu, TB, we don't change our behaviours based on those. And that's why we say this too will pass. We will eventually treat this as just another one of life's pitfalls, one of the things that will eventually kill us, but it's low down on the list right now. But the hysteria, and keep in mind that vicious triangle, people are now listening to the worst possible forecasts. Generally, the worst possible forecasts never play out. It's not to say they can't, not to say it might not, but they generally never play out. And that's when we see bounces come back in the market. I put this slide in last month, I put it in again, but in the last, 40 years here, these are the pandemics and the crisis we've had. And the market's always been ahead at the end, except for a couple of circumstances around HIV/AIDS, but we're in the middle of a deep recession that lasted 3 years at that point, and the recession wasn't caused by AIDS. So it's highly likely, no guarantees, that this too will pass and we will recover. Where we'll recover to remains to be seen. It's completely unpredictable, but we will recover. So let me talk about markets and what they've done. So I'm going to go through my usual order of talking about what happened during the month of February, and then obviously we've had a worse correction since. So Aussie shares dropped in February 7%. At that stage, the 1 year return was still sitting at around 8.6%. So about consistent with long-term averages, but we're down roughly another 20% in March, and I don't know where the market's going to open this morning. So we're going to be down around 25 to 30%, and it may be slightly more than that. That will likely see the worst of it. So in terms of our market assessment, we've gone from calling it expensive towards the end of January to calling it back to fair towards the end of February, and we're now calling it we're completely in fear stage. So that just helps us put into context, and it helps us help you tell in terms of guiding you on what to do when we're in those contexts. This never helps us predict anything because models can't predict the future. If I could predict the share market, I would be a trillionaire, and I'm not. Warren Buffett, who I've talked about in this presentation, makes no attempt to predict the market. In fact, he's gone on record this week as saying he's never seen anything like this. So he's seen worse financial crises, and the last two financial crises were much worse than this, but he's never seen a market hysteria like this, and he's 89 years old. So it's a first for Warren. But once again, the thing about being in the fear stage is it is the eye of the storm. It is when things seem the worst, and even though they may get a little bit worse, they will eventually get better, and we will see rebounds. And US shares were down about 4.65%, so that was less than the Australian market, largely because the Aussie dollar drops during these crises, so we're protected by that, so that's a good thing for the diversification. But you'll see the top chart there is the 1 year chart, so it shows the steep drop we've had again since February finish, so we're down another 20%. But you'll note there in the US, so for us Aussies investing in the US, we're back to where we were at the start of the year. So we've only gone back a year. It's not actually that bad, and it's certainly not as bad as it feels. And once again, that's the emotion driven by the media. The bottom chart is the 10-year chart, and the 10-year chart still looks pretty cool. We've dropped that red line. Excuse the background noise as a plane flies over me. That red line is the 200-day moving average. So whenever we substantially get a fair way away from that, the market often swings back to that longer term trend. And we've seen it go from well above to well below in the last little while. So we're in that fear stage. So US small caps have dropped more in line with Aussie shares. They tend to grow higher than large cap shares and fall harder. They're down 6%, and you can see that drop off. They are down for the year. So they're down about 14% for the year, and for March they've dropped another 20%. They were of course up very strongly in the lead up to this, and we're absolutely in the fear stage there. Our global leaders, so this is IOO, which we hold in the active portfolio. At the end of January we were still up 20%. We're only down 5%. In fact, we took a little bit of a profit in the active portfolio. We did sell out at a certain point. We did buy back in around about that 200-day moving average. Would have been nice if we were buying back in now instead of then. But we have a framework. We stick with that framework because we know it works for our clients who have a long-term outlook. It's down again further, but once again, it's still slightly up for the year. For us Aussies who've invested in this, you'll see it a year ago, it was just above $66. And it's around that 67. As I did say, these will be prices from yesterday. They'll go a bit later, but we've just given up the year's worth of gains, which is not that terrible. All of these charts, by the way, exclude dividends. So we've had the income. So had we put all our money in the bank at the start of the year, we would have got 1% in interest or from bonds. So for the share market, we've had about 6% dividends from Aussie shares, and we've had 2 to 3% from international shares. So even giving up all the gains, we still have had more income than we would have had from cash. So these global leaders absolutely in fear mode as well. Emerging market shares initially didn't drop by as much. So to the end of February, they were only just down a fraction, but they did capitulate along with the rest of the world when the oil price dropped and then further compounded by Trump and other authorities around the world overreacting and doing it ineffectively. So we've seen a big drop there this week as well. And they're down a fair bit. The bright part of the portfolio, gold, was up 5% in February. It's up further in March, but it's only up about 3%. So I feel like gold's sort of peaking. That's a bit of an indicator that we're at the top of the fear factor. When gold starts to drop, that'll be a sign that the fear is diminishing. There's another index called the VIX index, which is the fear indicator. It's higher than it's been since 2010, which is normally a sign we're near the bottom of the market because we're in fear. We hold gold regardless because we know we live in a volatile world, and it's done well for the portfolios. I will put up the portfolio performance. Note this is to the end of February, so the portfolios are down further as we speak. Where they'll be at the end of March, who knows? They may have rebounded by then. I suspect that will be the case. So if we look firstly at the 1 month performance, we see our high growth core portfolio down 7.5%. And the order of this is as it always should be. The growth portfolio is down less. So for balanced investors, which are many of our clients who are retired, down about 4.5% in that month. If we fast forward out to the year, still up for the year. So the year, and this is to the end of February, so a balanced investor to the end of February, with all the dividends included, would have had a return of around 6.8%. When we add in the A and the E, that was more like 8% still for the year at the end of February. So these returns were good. In fact, they're pretty close to our long-term targets of inflation plus these numbers. And inflation at the moment would be lucky to be running at 1%, and we'll probably see it drift lower. But let's call it 1.5%. So we'll see that we're bang on or pretty close to those sort of numbers. I just had a quick look at some of the portfolios. and the balanced performance is probably down another 6% in March. So that'll wipe away potentially the 1 year gains, but not, that's in the middle of the month, and we may see some recovery from there. So we're back a bit, but we're not back too far. And more importantly, it's about what you do. So let me talk about the bear market survival tip. And this never changes. This is not something new that is with this panic. This is the fact that human nature never changes. We get this pendulum, this cycle from fear to greed or fear to FOMO. We've seen it pull all the way back into fear mode. It's the first time when we look at the history of the Australian share market, or at least back to 1890, that we've seen fear arise where we haven't been in FOMO first. So that is a first. But we've come back into that fear. It is a pendulum. It will swing back. So the first tip or advice is don't panic. You have a good plan. So where you have a good plan, it's been designed knowing that these things are inevitable and that they will come along. So our first advice is at the very minimum to stick with your plan. For our accumulator clients, that's those that are still working and adding to their investments, just keep averaging. This is the biggest sale in your lifetime. It's the time to be buying, not the time to be selling. For retirees, it's drawing down exactly as per the plan. That's why we have the reserves portfolio, so that we can draw down from the cash and short-term fixed income portfolio, which is doing fine, by the way. It's ticking away and it's boring 1 to 2% or 1 to 2.5% range, and that's where your pension payments are coming out of. So we're not panicking and selling. If you've got cash or capacity, this is a massive sale. It doesn't mean it might not turn into a slightly bigger sale. So you could consider buying. You could consider moving up one risk profile. So what I mean by that, you don't need to do these, by the way. This is only for those that are feeling brave and would like to do something to take advantage of the fear zone that we're in. You could consider moving up one risk profile. So if you're a balanced investor, you could go up to a growth investor. That effectively adds around 20% of equities to your portfolio from where you are now. You could bring your reserves down by 1 year. The reason we hold reserves in that sort of 2 to 4 years mark is to survive through these. Given the market has now dropped, using a year's worth of reserves, if you had them to buy into the market, will likely buy at a low time and add to your returns over time. The main thing is to turn off the news. I know you won't be able to do this, by the way, and I can't do it, but be very careful of your news. Try and gravitate towards true journalist sources. We're seeing some good articles from The Spectator in the UK. We're seeing terrible stuff from the mainstream media, particularly the breakfast shows and all these things. Turn them off. They are loving this. They pretend that they don't. They love this because they know they've got people glued to them. As they do things like interview cleaners off planes. It's the rise of the extreme view, the vicious triangle. And the masses who watch Koshi and Carl and whoever else they are, they're the ones emptying the shelves of the toilet paper. The world is in the best time it's ever been in history, but we have a generation that feels like it's in the worst time. And it is because of that vicious triangle where we look to make everything a crisis, and then the nanny state jumps in to protect us. We have far fewer people dying of all diseases than ever before in history. We have a more prosperous world than ever before in history, and yet we don't feel like it. It's extremely frustrating. The world has gone mad, but it does that from time to time. So it is reality, and I can't reiterate this bear market survival tip enough. If you feel the need to talk to us, please do. We haven't seen our clients rushing for the phones or panicking. We've had a few calls. We tend to get calls from people that are relatively new to the market. Our clients that have been with us for 10 to 20 years have been through this before. They know that this passes. They know that this is the time to stay firm. It's a time to not panic. And this is where, to heed Warren Buffett's advice, we will make money as the masses get fearful. And if we remain at the very least firm, we will recover from this. So I'll finish with reinforcing our process, because the process works. Your plan is based on your goals, and the portfolios have been designed to meet those goals. We take a long-term view because in the short term, the market is always unpredictable, unknowable and volatile, and we're seeing that quite clearly right now. Diversification has helped your results during all this. You saw the results there. They're much better than just being in the share market or just being in any individual sector. We've rebalanced the portfolios this week. That means we've been buying shares in the core portfolios. We will probably rebalance them again. And that just means we're doing the opposite of the masses, buying growth investments, that's shares, when others are selling. And maintaining our asset allocation. We have low cost exposure to the market that comes through in good returns. We do offer some protection against short-term volatility. We did take some profits in the active portfolio. Our enhanced managers did have a degree of cash, and I note our Australian share manager, Joseph Palmer and Sons, are busy buying right now. And we've been rebalancing the portfolios. All those things provide some protection against short-term volatility, but the biggest protection you will have is by smart behaviour, smart decisions during this time. We hold the reserves for our retired clients, and we're dollar cost averaging for our working clients and those that were just easing into retirement. So dollar cost averaging to build in. We were dollar cost averaging in for new money, for new money into the market over about a year. We're very comfortable for people getting into the market right now, putting it all in for those that are brave enough, but we would certainly recommend bringing forward a good chunk of your available cash to get into the market for those retiring. Rebalance regularly, which we're doing. And just remember, there is only 3 ways to lose money in the markets, and don't do these. The first is when you panic and sell. The second is when you have to sell because you need the income. And if you've planned well, as you have, you don't have to sell right now. And the third is if you're not properly diversified. And all of you are very well diversified, and we see the benefit of that at this times. Now, I haven't included a property section in this update. I wanted to spend extra time on the current crisis. Property markets don't react like this. It'll be interesting to see what they do. We never know till a bit later, but they're fairly stable. I will point out one major thing. For those of you that were going to sell a property at some stage in the next few years and then end up in a diversified portfolio for retirement, we often say let's wait till a bull market in the property market and then do it, but we've got the exact equivalent right now. With property markets stable and share markets down 20 to 30%, the switch over from property to shares is as good as it gets right now. So if that is part of your plan, and we will of course talk to all of you individually in the coming times at your reviews, and there's no reason for any knee-jerk reactions. If your circumstances have changed, if you're particularly worried or you want to take advantage of opportunity, talk to us. I'm scheduled to fly to Sumatra next Tuesday. Let's see if travel bans don't stop me, but that will be the only thing that will stop me. I will have Wi-Fi. I'll be on a little remote island with some friends and my son surfing. I will have contact. I have a marvellous team who can answer questions. They have access to our marvellous investment committee who can put things in perspective, and in emergencies I will have Wi-Fi and be able to communicate. But I would say get on with life. This too shall pass. Life's pretty good for the most. I was in Sydney yesterday, and I was pleasing to see Sydney-siders getting on with life. I only saw a handful of people in masks. I only saw one person sheepishly carrying a 32-pack of toilet paper down Pitt Street, and he did look rather embarrassed. But I'm told that's all you can buy in some places. And people were going about their business. I was standing in a queue getting food, and no one was trying to distance too much. You should practice some safe hygiene during all this, and wash your hands. Don't do all the things that we should do every flu season, but make no mistake, this is just another flu season. The reaction to it is causing all the dramas and has put us into the fear zone, but the fear zone does provide opportunity, and the minimum of that opportunity is to stand firm. Your portfolios and your plans are in reasonable shape. I'm going to sign off now. I hope you all have a great day. I didn't want this to be a doom and gloom presentation, and because we're not in that state. We've got hysteria, And I'll leave you with one thought. When you look at the world through the eyes of the media, particularly the short-term media, particularly the Koshis, the Carls, particularly the extremists, life can kind of look like a pile of poo, and excuse my words there. But when you look outside, when you look at the real world, when you look at what's actually going on, it actually looks pretty good. It is the best time ever as the human species to be alive. It just doesn't feel like that, and that's why turn off the media, don't look at that pile of poo, and that's why the masses have hoarded toilet paper. Rob McGregor signing off. Have a great day, have a great month. I'll be talking to you soon and look forward to catching up over the next month with most of you.